You're all very, very kind to be here listening to a banker gargle on about the economy when we could be out having a margarita by the pool. So thanks very much. And thanks to Center Cafe again for letting BDH give our thoughts. Coffee for us is the single largest product that we finance. So this is a very, very important group of people for us in this room. So thanks very much. One of the topics I think are on sort of the center of most economists' mind right now is when exactly this environment of zero interest rates in the United States is going to stop. You can see here, this is a chart of the federal funds rate, target rate, and then also the futures forecast. It has literally looked like this for like the last 3 years if you look at the futures market. So we've been going on and on and on saying, well, the Fed's going to raise rates soon, the Fed's going to raise rates soon, and then they continually keep kicking the can. We thought that they would probably raise rates at the end of this year, although now the consensus is that there's probably only about a 30% chance that they raise rates in December. And I'll get back to this. But there's a lot of stuff that goes into their thought process in when to actually raise rates. I apologize for people who have heard this part of the presentation before, but I think it's important to set kind of a framework for the forces that drive the economy. So in the United States, we live in a consumption-driven economy. So it's consumption by the American households and consumers that drives GDP in our economy. There are really two things that go into that consumption. One is the wealth effect. For most people, that's the value of their house. If your house is appreciating in value, you feel wealthier, you tend to spend more money. The other is the income effect, and that is, of course, the employment market. Then there's a couple of things that are deterrents to GDP growth, and those are deleveraging, which is paying down debt, and saving, which is similar to deleveraging once you have paid down debt. When you're saving or paying down debt, you're not putting that money into the economy. There's also kind of a third one, which is taxes. And that doesn't necessarily mean income taxes or sales taxes, but even, for example, energy, when energy prices are high, kind of serves as a tax on consumers. So here's just a chart of what the typical or the aggregate American households look like. And you can see up here, the red line on the bottom, I don't know how well you can read this, but the red line on the bottom is residential real estate. So even though the real estate market declined following the housing crisis and the stock market has recovered, the average American's household is still about 28% of their net worth. So that's a really important thing in just determining how good people feel is the value of their house. This just shows the housing prices. The blue line is the median home price in the United States. The red line is actually the change in price. So even though the red line is going down, it doesn't necessarily mean prices are going down. They're still appreciating at about 5% a year, and back to the levels that they were before the housing crisis. So that's a positive for the economy. It's largely due to this factor, which is that mortgage rates have been at exceptionally low levels for quite a period of time now. A 30-year mortgage right now is about 4%, which is just remarkably cheap when you consider that that's 30-year money. So one of the things that will be interesting to see as rates start to come up, and this doesn't necessarily mean short-term rates. When the Fed raises its short-term rate, that may not necessarily impact mortgage rates because mortgage rates are for a much further period of time in the future. But right now, housing is very affordable because of mortgage rates. So that's something that the Fed is going to consider as they're thinking about trying to push up rates. And one of the things that they have stopped, as people probably know, is this concept of quantitative easing, which instead of just adjusting rates was effectively buying various longer-term dated securities, which also help to push down long-term rates, which would be mortgages. So that's the housing, the wealth effect from housing. Now here's the income effect. The blue line on the bottom here is the official unemployment rate. Perhaps the more important is the red line on the top, which is the underemployment rate. So that would include not just people who have filed for unemployment, but people who have given up and are no longer filing for unemployment, or people who just are working part-time, working in a job that isn't wouldn't provide their normal income stream. So whether you're unemployed or you're underemployed, odds are you're probably not going to be spending anything that you don't have to. So you can see that the unemployment rate at 5%, the official rate, is okay. It's getting better. It's certainly much better than it was a handful of years ago at 10%. The underemployment rate is still a little higher than it has been historically. So that's another thing that the Fed is watching very, very carefully as they determine where to set rates. This is just a chart of the average hourly earnings growth, and you can see it's hovering right around a little over 2%. That's effectively flat once you take into account roughly 2% inflation. And then getting to those deterrents that I mentioned, the deleveraging of the American household. So right prior to the credit crisis, average American had debt that was about 129% of the value of their income. Just to put things in perspective, the U.S. government's leverage is just over 100%. So we as people were even higher leverage than our government. Just to put that in perspective, when you think about the $18 trillion of debt that we have as a country. That has been corrected significantly. The bad thing about that is that that's money that's not going into the economy being spent, going into producing corporate earnings. The good thing about that, in the long run, is it makes our economy much more durable because, one, people have a lower debt service, so that if there is a break in the economy, it's not quite so severe to them. The other is that people are saving, and that just provides simply a cushion. If you have a savings account with some cash in it, you're going to be a lot less likely to panic and cut off all your spending when there's a blip in your income. And similarly, corporate balance sheets in the U.S. have been doing the same thing. Companies have been delevering. Corporate cash right now in the U.S. is just over $1.6 trillion. So U.S. corporations are in a much, much healthier place than they were heading into the credit crisis. This is just a chart of the retail sales and personal consumption, which kind of match. I mean, for most of us, our consumption is retail sales. You can see they bounced back certainly from the recession. They're still, relative to historical norms, kind of lackluster. So while the economy has recovered, it's certainly not booming. It's kind of moving along at a slightly sluggish pace. Here's the measurement that everybody looks at, GDP growth. A recession technically is 2 consecutive quarters of negative GDP growth. One thing that's interesting is that in the last 2 years, we've had very, very sluggish first quarter of the year. Part of that, we think, is actually just weather. We've had a couple of very, very cold winters in the north. I just moved to Boston in January, and I can tell you it was the most snow we've ever had on record, and it was a miserable time to move into the city. But the economy is sort of a healthy GDP growth would be around 2.5% to 3%. We're probably growing, if you smooth everything out, slightly under that. And that is, of course, driven in part by the performance of corporations in the U.S. So here's a chart of the S&P 500, which is the 500 largest publicly traded companies. in the U.S. and their earnings growth year over year. So the red lines here don't mean that they're posting losses, they just mean that their earnings are less than they were the prior year. So we've now had 3 consecutive quarters of earnings declining for U.S. corporations. Part of that is because if you look at the chart, you see the red area, which is right around the recession, and then you see very quickly corporate earnings bounce back. That's due to cost cutting. So it's very easy to get your earnings up in the short run by cutting costs. However, you cannot cut your costs below zero. So at a certain point, it becomes unsustainable to continue cutting costs. We're now at a point where the only way earnings are going to grow within corporate America is by increasing consumption and demand growth. So there's actually been some negative pressures. The good thing about personal income increasing is that we're all doing better as individuals. The bad thing about that is that corporate America has a higher cost of maintaining their employees. And so that has put some pressure on earnings, and we're slightly concerned when we look out over the next year or so how much corporate America is going to be able to continue growing earnings given those factors. And so I mentioned that wages are up. Wages are up more than productivity is up. So it's okay as a company to pay your people more if you're going to get more out of that. However, productivity relative to wage increases is slightly down, so that's also kind of put downward pressure on earnings for corporations. So coming back to the interest rates. One of the things, so historically the Fed has basically focused, when they look at interest rates, on 2 things: unemployment in the United States, and the second is inflation. The Fed targets about 2% inflation. A little bit of inflation in the economy is a good thing. It allows people to make slightly more money each year, and it basically provides a confidence boost to the consumers. The nice thing about right now, we're right under 2%, so just in terms of inflation, just a little bit under where the Fed would like to be. So the Fed has the ability now, given the fact that we're now down to 5% employment and sort of back to normal economic metrics, the Fed has the ability to increase rates, but because inflation is at bay, they do not have to increase rates. So they're now looking at things that are a little bit unusual, such as what's going on around the rest of the world. Obviously, a lot of people are talking about Brazil. China has had a big impact on the U.S. market when it devalued its currency. So the Fed's going to be looking at all of those things as it considers when to raise rates. One of the problems for the United States is the dollar is getting very strong. Brian, you asked a question about that. When the Fed starts to raise rates, in theory, that should actually attract more investment into the United States because we would be paying a higher yield basically on dollars. That makes us less competitive on exports. So when the Fed starts raising rates, it is going to likely put more upward pressure on the dollar and more downward pressure on other currencies. And despite the fact that the Fed is mostly concerned about the U.S. economy, they're also concerned about the global economy because they are, in fact, intertwined. So this is just a chart of inflation. You can see the blue line is the CPI index, which is the sort of the official measurement of inflation, but that includes food and energy, which are really commodities, and so everybody knows what has been happening with food and energy prices lately. So probably a more meaningful line is the red line, which is much more stable. That just pulls out the commodity price volatility, and it measures just a basket of normal consumer goods. So we're sort of on target for inflation. With that said, one of the concerns of the Fed not raising rates quickly is if they hold rates low for too long, then they may be faced with inflationary pressures and then having to raise rates more quickly to counter that. Right now, I think they're more concerned with deflation or underinflation, but inflation, as anybody in Brazil knows right now, does not take a whole lot of inflation to ruin your day. This is just a chart that shows the impact of inflation on purchasing power. So there's a difference between money and wealth. So money is just the dollar value of what's in your bank account. Wealth is actually what that can purchase for you. So if you had a 10% annual inflation rate for a 25-year period, $1 million today in 25 years, if you still had $1 million, the purchasing power of that $1 million would only be equivalent to having $200,000 today. So you can see how quickly just 10% inflation can deteriorate the purchasing power of money. So that's something that's very that's obviously a concern and something that Fed needs to look out for. This just shows, now let's talk about places that you can put your money and kind of the challenges of investing. The red curve here is the forward yield curve on U.S. Treasuries. So it's the theoretical risk-free, although nothing is ever really risk-free, but the risk-free interest rate you can get. So you're basically paying nothing in the short term, and if you go out 30 years, paying just under 3%. The line underneath it is the real yield curve, which factors in inflation. This chart is actually slightly dated, so it's using a 20.20% inflation rate. If you use a 2%,